not just, it has to be more than just a
I,
coincidence.
when you make an investment, you should have a thesis that you have relatively high conviction in. So when the stock goes down, as long as the information doesn't change, as long as there's not new data that changes your thesis, you should have a higher conviction now at the current price rather than a lower conviction. I think the big mistake that most retail investors fall into is we always think that someone else knows more than us. We think that if we make an investment and the stock starts to move the other way, well, I must be wrong. Well, again, you shouldn't have made that investment unless you have a really strong thesis that you think is being underappreciated by the rest of the market. And if the market continues to underappreciate that, you should get excited. So like when Amazon fell, I got really excited. You remember when Bloom Energy fell? I was actually excited that day when I messaged the group. I said, guys, I'm doubling down because I know why Bloom Energy dropped. It was a thesis that someone had on Oracle, and I know that that thesis is wrong. So once I realized why people were selling Bloom, I got really excited to buy more Bloom because I knew the reason why they were selling Bloom was wrong, at least